The other investment plan is public provident fund, that is PPF. If you have a girl child, then I would recommend you to join in Selvamagal Sempathitam, that is Sukanya Samriddhi scheme. If you have a boy child, then you can open an account on behalf of him. He should be below 10 years. So the minimum amount you have to deposit is 500 per year, and maximum would be 1,50,000. And to open an account, you need to give rupees 500. That is interest rate, that is from 1/7/2017 is 7.8%. The government keeps on revising the interest rate, so just get an update before joining in this scheme. So the maturity period here is 15 years, but the same can be extended within 1 year of maturity for further 5 years, and so on. If you want to withdraw, then you can withdraw from 7th financial year from the year of opening the account. Here the loan facility is also available and tax exemption is there. So how much ever you are depositing in PPF fund, it is tax exempted. That is, a guardian who's depositing for the children can be claimed for tax. So the deposit can be made in lump sum or in 12 installments. So this PPF account you can open in post office, and you can transfer from one post office to another post office if you happen to switch over the place. Here the nomination facility is available at the time of opening, and also after opening the account also it is possible. So if you want to retain the maturity value without extension, that is also possible, and without further deposit also. So here the balance in the account will earn PPF interest till its closure. So the next one is fixed deposit or recurring deposit. This is one of the safest avenues to save for our children, with capital being more or less secure. So some of the banks like Canara Bank, HDFC, Bank of India, that allows a minor to open a fixed deposit account. Parents or legal guardians are also allowed to open on their behalf of their children. So here the withdrawing funds before the maturity is simple, and also one more advantage is that the minimum amount required to be deposited is very less, and in many cases the interest earned on the amount deposited will be deducted from income tax. So the other investment plan is mutual fund. There are two main avenues. One is debt and equity. Debt is generally considered to be a safe investment. The only flip side that is that the returns tends to be limited. But equity funds, when people invest for over a long period of time, that is for years, they had received good returns. So basically, if you want to invest for less than 3 years, then you can go for debt investment, since generally it is less risky than equities. But if you want to invest for more than 3 or 5 years, then you can go for equity funds, because over an extended period of time it generally overrides the risks, and also like you can get good returns. So when you take inflation into account, usually when you invest in debts like fixed deposit, the returns is very minimum, that is single digit. For example, if the returns in fixed deposit is 10% and the inflation rate is, for example, 6%, what you will get the returns, that is only 4% you will get the return. So what you should do is always you should start early and invest regularly. So once you have set up your monthly investment plan, you can enjoy your newly acquired bundle of joy. So many mutual funds have children specific schemes, like which it will focus the investment into combination of debt and equity, with the emphasis on a capital preservation with modern returns. So these are typically long-term funds with an investment horizon of 9 to 10 years. Like if you want the money that is less than 5 years away, then you have to consider debt and balanced funds. So if your need is more than 5 years away, then you have to consider an aggressive portfolio consisting of equity funds, and one balanced fund will be ideal. So the next one is child plans. These are insurance covers that pays out a lump sum to the child in the event of parents' untimely demise. So many critical events like higher education, marriage, other important landmark events of the child will be covered using the insurance plan. Many insurance companies have provided multiple features according to the pricing. So this insurance is mainly used to take care of the child's landmark events, as I said, in upbringing. So some insurance companies also provides permanent disability benefits of the guardian whoever has insured for the child, and here there are tax benefits also. So here also you have flexibility to make partial withdrawals. So mainly the investment returns will be paid out to the child at regular intervals. Next but very important thing is time. You need to spend a lot of quality time with your children. This is the best investment that you can ever give to your child, because no one can replace you as a father or mother for your children. So time is the best thing. You give lot of time. Either you can provide inputs for financial education or physical education or play time, whatever it might be. Time is the one of the good and best investment. Thank you so much for listening this video. If you find this video useful, please subscribe to our channel We People and like and share with your friends. If you have any query or clarification, please provide that in the comment section. Thank you.